Hi there. Welcome to my course on Real Estate Investment Trust, otherwise known as REITs. I have designed this course as a crash course to help the students get a strong understanding of real estate investment trust in less than 1 hour. This course will give you a high level understanding of REITs, understand the different types of REITs, and also the different financial aspects of REIT. This course will give you a practical insight into the REIT market, and also the students would be able to appreciate the different aspects of a REIT as a financial product. Without much ado, let's get started with the introduction. In the introduction lecture, what I intend to do is to define what REITs are, explain you the different components of REIT returns, and then we'll also look at how REIT performance compare as when compared to S&P 500. So let's first understand what a REIT is. A REIT is an investment vehicle that pools money from investors and invest in income producing real estate. So here the key thing to understand is that this is a financial product which trades like share in the market, but the underlying is a real estate asset, is a physical real estate asset. And REITs is a very important asset class for investors who are looking for income. This is because a REIT tend to have very high distribution yield. Even for a blue chip, 5 to 6% distribution yield is not very uncommon. So that is why for any income portfolio, REIT forms a very important asset class to be included in the portfolio. Another key thing to notice that unlike the popular conception, real estate is considered as a type of alternative investments. REIT is an investment which falls under the alternative investment class. In the real estate, you have listed real estate and you have the unlisted real estate. When I refer the unlisted, it refers to the actual physical properties. The listed real estate refers to the REITs, which trades like a normal stock in the market. Okay, and so when I say it trades like a normal stock, it means that the price keeps on changing throughout the day, just like a share. The only difference is that in case of a share, it represents a business, while in case of a REIT, the underlying is a physical property. Later on, we'll go to the details in subsequent lectures how REIT is managed, what are the legal structure, and the other details. In a well diversified portfolio, we need to have different type of asset classes like stocks, fixed income, commodities, as well as real estate. Now, a well diversified portfolio helps to achieve better risk adjusted returns as opposed to a concentrated portfolio, because when we combine different asset classes with negative correlation, it tends to increase the risk adjusted return of the portfolio. REITs offer a highly liquid and a cost effective way to diversify the portfolio into real estate. When you buy into a physical real estate, one of the key issues is that it's highly illiquid. While in REITs, investors can buy and sell the REIT shares just like they buy and sell a normal stock. So one of the key highlights of REIT as a financial product is that it offers high liquidity, and also the ownership cost is less because you're buying into fractional units of a REIT trust. Now let's understand what are the components of REIT returns. So, like investing in a dividend stock, there are two components. One is returns from your capital appreciation, second is returns from your dividends. So, similarly, in the REIT world, you have return from distribution and you have return from increase in unit prices. The key difference is that REIT tend to have very high distribution yield, as the REIT structure is designed by law to distribute a majority of its net income to unit holders as distributions. In most countries, REITs are required by law to at least return 90% of the net income as distribution to shareholders. So this explains why REITs, as by design, have such a high distribution yield. Now, as the implication of this, because most of the earning is distributed to the unit holders, as a result, the retained earning is pretty less in REIT, and hence, when there is little income left to reinvest in the business, so the growth element in REITs is comparatively lesser as you observe in stocks. That is why the return from unit prices is modest. But overall, when you combine the return from distribution and return from increase in unit prices, overall it is in the long term it tends to beat the stocks. Okay. Now that you have understood what REIT product, let's get some appreciation on to see how big is this REIT market. So you see, not every country has a well-established REIT market. So as expected, US has the biggest REIT market in the world, which is close to $1.2 trillion. Okay, but one key thing to notice that for US, because US is a very big market, US is the largest stock market in the world. So as a percentage of the total stock market, it only is 3%. While you see other countries like Singapore, which has a relatively total stock market is less as compared to US, but the REIT market is pretty large on a relative basis. You see, as a percentage of stock market capitalization, REIT market represents around 12% of the total stock market in Singapore. The other notable markets are Australia and Japan. So Australia market is also 90 billion, and Japan also 121 billion dollars. Okay, so this matrix lists the largest REIT market as a percentage of stock market cap, and Singapore is on top because it has a relatively a smaller total market cap, while REIT market is much bigger than other countries in the relative terms. Okay, now let's get to see the asset class correlation metrics. Now REITs are a different asset class altogether. So so this one shows the correlation coefficient between the different asset classes. As you can see, REITs when compared with S&P 500, the correlation is pretty high, around 74%. This can be explained by the fact that REITs are also listed products like stock market, like stocks. So the volatility in the unit prices is also high, but is relatively lesser as compared to shares. Okay, and you see, REITs have a negative correlation with cash, similar like S&P 500 also has a negative correlation of cash. This can be explained by the fact that both REIT and shares tend to exhibit inverse correlation to interest rate. Higher is the interest rate, lower is the valuation of REIT unit value. Okay, okay. And in this module, we'll look at the historical performance of REIT versus S&P 500 in different inflation regimes. So what this chart shows is it kind of categorizes the three different inflation period. One is the low inflation, second is the moderate inflation, and third is the high inflation. In the low inflation is categorized as 2.5% or lower, while the moderate inflation is categorized as 2.5% to 7%, and while high inflation is categorized as 7% and higher. So as you can see, in the low inflation regime, the stock market or the returns from the stock markets tend to outperform the REITs, because whenever interest rates are less, and when is interest rate less? When there is less inflation in the market, in the economy. So when the rates are less, what happens is that stocks tend to outperform REITs. While in case of moderate inflation and high inflation, when the interest rate tend to increase, the sensitivity of the interest rate is very high, both in case of S&P 500 and REITs. However, overall basis, REIT tend to outperform. This is mainly because of the high income component of REIT. As I've explained in the previous slide, that REIT, a component of return from the income part, is pretty high. So, and in most of the property tenancy agreement, there is a inflation clause. So as inflation increases, the rental also is inflation adjusted. That is why in moderate or high inflation times, the REITs tend to outperform S&P 500. Okay. And also key thing to notice that you look at this graph also shows you the split between income returns and the price returns. You see the income returns from REITs is always higher than the stock markets. And while the price return is typically less, as I've explained in the previous case, because of the low return earning, the unit prices do not appreciate as much as the stocks. So the growth element in REITs is less, but the income element is pretty high. Overall, REITs have tend to outperform stock markets in moderate inflation and high inflation regimes. Okay. Okay. So in this lecture, this is the final part of the introduction section. So here we look at which particular sectors of REITs have outperformed S&P 500 when we compare the annualized returns. You see, so this is for a period between 1994 to 2021. The average S&P 500 return is around 10.8%. You see, most of the REIT sectors have outperformed S&P 500, and the self storage has the highest return. Self storage has average return was 18.8%, while S&P is 10.8%. So that is like massive outperformance. Similarly, industrial 15.8%, massive outperformance with respect to S&P 500. Residential 14.4%, healthcare 12.7%. So most of the REIT sector has easily outperformed S&P 500 in the long term. So this introduction was to show you the basics of REIT, and also to kind of give you appreciation of why REITs are such an important asset class, and given the fact that historically over the long term REITs have outperformed S&P 500. Okay, that's all for the introduction section. See you in the next lecture. Thank you. Thank you.